Do you feel like debt is controlling your life? We're going to talk about a really helpful strategy called debt consolidation that could make a big difference for your finances. Okay, let's start with the most important question. What is debt consolidation? Typically, it's when you have a bunch of different bills, usually credit cards, maybe medical debt, sometimes payday loans. You take all that debt and roll it up into one single loan, often called a debt consolidation loan, personal loan, or personal installment loan. The goal of consolidating debt is to simplify your finances and hopefully get a lower interest rate, so you can save money and potentially pay off your debt faster. Combining multiple balances into one loan should make your life a lot easier because you'll have fewer due dates to remember, fewer balances to keep track of, and fewer chances of forgetting a payment. Debt consolidation loans usually offer more competitive rates than credit cards, which means you could pay less interest overall and put more money toward paying down your principal and paying off your debt for good. Here's how it could work. Say you have 3 credit cards, each with a $5,000 balance. The average credit card rate right now in the US is 24.33% APR, which means if you took 4 years to pay off your credit card debt, you'd pay over $8,500 in interest. Now, watch what happens if you take your $15,000 credit card debt and move it to a debt consolidation loan at a rate of 6.99% APR. That same balance ends up costing you just over $1,600 in interest, and you'd pay it off a whole year sooner. Think about that. That is a potential savings of over $6,000. That is huge. Why such a drastic difference? In this example, it all comes down to interest rate. A 24% APR versus a 6.99% APR is significant, especially when you're paying off a big chunk of debt, like the $15,000 in our example. But that's not all. You could save even more on interest charges just by paying down your debt faster. If you got a lower interest rate and lower monthly payment, you could take that extra monthly savings and put it toward paying down your principal. Let's take a look at our example again to see what I mean. Remember how we consolidated $15,000 of credit card debt with a 3-year debt consolidation loan at 6.99% APR? With this example, we reduced our monthly payment by about $30. If you put that extra $30 monthly savings toward paying down your debt, in addition to your regular monthly payment, you could pay off your debt 2 months sooner while saving over $100 in interest charges. Okay, I know this all sounds great, but before we go any further, let's clear up any confusion about what debt consolidation is not. Debt consolidation is not the same as debt settlement, which is when you attempt to negotiate with your creditors to reduce your debt. And it's different from bankruptcy, which is when you take legal steps to clear your debt. These options may provide debt relief, but debt settlement and bankruptcy are for really serious situations when you have no other choice, since they have lasting financial consequences. Another option that's more similar to debt consolidation is called a balance transfer. This is when you open a new credit card that usually has a special low APR offer. By moving your balances to your new card and locking in a lower rate for a specific period of time, you can avoid higher interest charges while you work on paying down your debt. Balance transfers are a decent option if you want to avoid higher interest charges for a while, but keep in mind your balance will go back to the standard rate after the intro promotional period, which can last as long as 24 months for some cards. Plus, balance transfers may not improve your credit score the way a debt consolidation loan can. I'll talk more about that in a minute. For now, let's focus on debt consolidation, since it's a popular method of debt relief that has a ton of potential perks and could suit just about anybody's financial situation and goals. Before we get to some of the pitfalls and reasons a debt consolidation plan can fail, let's recap the major pros of a debt consolidation loan, which could include getting a lower fixed interest rate. Debt consolidation loans usually have rates that are lower, sometimes much lower than your average credit card. Plus, unlike credit cards, debt consolidation loan rates are fixed, which means your monthly payment stays the same for the life of your loan. And thanks to a lower fixed rate and potentially lower monthly payments, you may be able to pay off debt faster while saving on interest charges. It's up to you, of course, and how motivated you are to pay off your debt. You could put your monthly savings towards paying down your debt faster, or you could put it toward other financial goals, like building an emergency savings account or catching up with other household expenses. Another benefit to a debt consolidation loan is that you'll get a fixed term. This means you'll know exactly when your debt will be paid off, and you'll have just one monthly payment to keep track of, instead of multiple credit card bills and debts to juggle. Finally, maybe best of all, consolidating debts could improve your credit score. Our study found some users' scores increased by 80 points or more in less than 3 months. This is due to credit utilization, a key factor in your credit score, which tracks how much credit you're using compared to your credit card limits. The more credit you use, the worse it is for your score. Debt consolidation loans don't count toward your utilization, so using one to wipe out your credit card balances can be a serious boost to your utilization and overall credit score. This all sounds great, but I know what you're thinking. What's the catch? All I can say is, you're right. Debt consolidation is not a perfect solution for your finances. I've rounded up a few of the most common issues and complaints that pop up with debt consolidation. Let's start with the biggest. Debt consolidation doesn't fix bad habits. Say it with me. Debt consolidation will not fix overspending, mismanaging your budget, not making enough income to keep up with your expenses, forgetting to make payments, or any other financial stresses you might be facing. It can be a fantastic tool for reorganizing your debt, but if you move all your credit card balances to a debt consolidation loan and then immediately start racking up credit card charges you can't pay off, you're in a potentially worse situation than where you started. Before you choose debt consolidation or another type of debt relief, it's worth taking some time to review your finances and reflect on your goals. If you don't address the root cause of your debt, you'll struggle to improve your situation in the long term. Your financial habits are obviously the biggest factor when it comes to being successful with debt consolidation, but there are a few other features and potential downsides to consider too. First, you should know that some consolidation loans charge fees, such as an application fee or an origination fee. Any fees are usually reasonable and should be clearly explained upfront, but it pays to shop around and compare your options, since not all lenders charge them. And why pay a fee if you don't have to? Am I right? Another factor to keep in mind is if you don't qualify for a lower interest rate, you might not be able to save a ton of money or pay off your debt as fast as you want. Obviously, the best rates go to borrowers with the best credit scores. Those with lower scores could wind up with higher rates in the double digits. If you have less than perfect credit, you could ask a trusted friend or relative to act as a cosigner on your loan to help you qualify for a better rate. Another option to help get a lower rate is to choose a secured loan, which is when you use one of your assets, such as a vehicle or a piece of jewelry, as collateral to guarantee you'll pay back the loan. Secured loans usually have lower rates, but know that the lender could keep your collateral if you default on the loan. If you're still with me, awesome job. You're clearly doing your homework and taking the right steps to improve your finances and your future. The bottom line of all of this is you have options when it comes to debt consolidation. Go to LendingTree.com to compare your potential rates, loan amounts, and repayment options. You can get more details and see what you might qualify for with no cost, no commitment, and no credit score impact. LendingTree will help you compare multiple lenders and get personalized loan offers in as little as 2 minutes. And there you have it. See you next time.